Preparing for a financial analyst at NextEra Energy interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What do you know about NextEra Energy's business model? NextEra Energy combines regulated utility earnings with competitive clean energy development. I would describe the two main platforms, Florida Power and Light, which earns regulated returns on approved investments, and NextEra Energy Resources, which develops, owns, and operates renewable and storage assets. The financial profile therefore depends on rate base growth, project economics, power prices, tax incentives, and capital access. Understanding that mix helps explain why analysts separate segment drivers carefully. While answering, focus on the distinction between regulated utility earnings and competitive energy development, including rate base growth, renewable generation, storage, power prices, tax incentives, and capital requirements. Question 2. How would you analyze NextEra Energy's revenue and earnings drivers? I would begin by separating FPL from NextEra Energy Resources because their earnings drivers differ. For FPL, I would examine customer growth, usage, regulatory rate adjustments, fuel recovery, storm costs, and allowed returns on rate base. For NEER, I would analyze generation, contracted prices, project additions, production volumes, hedging, tax credits, and merchant exposure. I would then reconcile segment results to consolidated net income, adjusting for financing costs, depreciation, and unusual items. Make sure to cover regulated customer demand, approved rates, weather, fuel recovery, renewable project additions, contracted versus merchant revenues, operating costs, depreciation, interest expense, and non-recurring items. Question 3. What is rate base, and why is it important for FPL? Rate base is the regulated asset investment on which a utility is allowed to earn a return. At FPL, it can include generation, transmission, distribution, and other approved infrastructure, net of accumulated depreciation. Analysts forecast rate base growth by adding capital expenditures and subtracting depreciation, then apply the authorized return and capital structure. Growth is valuable because it supports earnings and cash flow, but regulators require demonstrated customer benefits and prudent investment. In your answer, explain the definition of rate base, approved capital investment, depreciation, allowed return, regulatory lag, customer benefits, and how sustained rate base growth can support utility earnings. Question 4. How does regulation affect your financial analysis of FPL? Regulation makes FPL's earnings more predictable, but not automatic. I would track rate cases, authorized returns, equity ratios, regulatory lag, and the treatment of fuel, storm, and environmental costs. Regulatory assets can defer expenses for future recovery, while regulatory liabilities can return benefits to customers. I would also test whether projected capital spending is likely to receive approval. The key judgment is distinguishing reported accounting results from sustainable earnings supported by regulation. Be sure to mention rate cases, authorized returns, prudence review, regulatory assets and liabilities, fuel cost recovery, storm recovery, regulatory lag, and the difference between accounting earnings and approved economic recovery. Question 5. What financial metrics would you monitor for FPL? For FPL, I would monitor customer growth, energy demand, rate base growth, authorized return on equity, capital expenditures, O&M efficiency, and regulatory recovery. I would compare actual earnings with the approved framework and investigate variance from weather, usage, fuel, storms, or timing. Cash flow matters because large infrastructure programs require funding. I would also track FPL's contribution to consolidated earnings and whether growth is translating into durable earnings per share. Focus on rate base growth, customer additions, energy sales, allowed return on equity, operating efficiency, capital spending, cash flow, regulatory recovery, and earnings per share contribution. Question 6. How would you evaluate a renewable energy project developed by NEER? I would build an unlevered project model beginning with capacity, expected utilization, degradation, power prices, and operating costs. Then I would incorporate construction timing, interconnection costs, tax credits, debt terms, and the contracted versus merchant revenue mix. I would calculate project NPV, IRR, payback, and debt service coverage, followed by sensitivities for output, costs, rates, and power prices. I would favor projects with strong resource quality, credible contracts, and manageable execution risk. In your answer, cover project capacity, resource quality, construction costs, operating expenses, power purchase agreements, merchant exposure, tax credits, financing, production assumptions, and risk-adjusted returns. Question 7. How would you value NextEra Energy using a discounted cash flow model? I would forecast FPL and NEER separately because their risk and cash flow profiles differ. For FPL, I would model rate base growth, allowed returns, costs, taxes, and capital spending. For NEER, I would forecast project additions, contracted revenue, merchant exposure, and operating costs. I would discount consolidated free cash flow using a risk-appropriate WACC, calculate terminal value carefully, subtract net debt, and test sensitivities. I would cross-check the result with comparable companies and sum of the parts valuation. Make sure to discuss segment-level forecasts, free cash flow, discount rates, terminal value, regulated versus merchant risk, capital intensity, debt, sensitivity analysis, and cross-checking against market-based valuation methods. Question 8. How would rising interest rates affect NextEra Energy? Higher rates would affect NextEra through several channels. Interest expense and refinancing costs would increase, while a higher WACC would reduce the present value of long-duration assets. Renewable projects could become less attractive if financing costs rise faster than contracted revenues. Utility customers may also face affordability pressure, complicating rate cases. I would examine debt maturities, fixed versus floating exposure, project-level financing, and recovery mechanisms, then quantify earnings and valuation sensitivity rather than assume a uniform impact. Discuss higher interest expense, WACC, project economics, refinancing risk, utility affordability, valuation multiples, renewable development pace, capital structure, and potential offsets from regulated recovery or hedging. Question 9. Which cash flow metrics are most useful when analyzing a capital-intensive utility? I would start with operating cash flow, capital expenditures, free cash flow, funds from operations, and dividend coverage. Net income can obscure cash needs because depreciation is substantial and capital spending is recurring. I would also review debt to EBITDA, funds from operations to debt, interest coverage, and working capital movements. For NEER, project-level financing and tax equity proceeds require additional context. The objective is assessing whether growth investment, dividends, and debt obligations are sustainably funded. Be sure to mention operating cash flow, capital expenditures, free cash flow, funds from operations, dividend coverage, debt metrics, working capital, project financing, and why net income alone can mislead. Question 10. How would you assess whether NextEra's capital expenditure plan is sustainable? I would compare planned capital spending with operating cash flow, internally generated funds, debt issuance, equity needs, and asset sale proceeds. Then I would test whether investment produces acceptable returns through rate-based growth or contracted project cash flows. I would monitor leverage, credit ratings, interest coverage, dividend commitments, and construction execution. Finally, I would stress test delays, cost overruns, lower generation, and higher rates. A sustainable plan preserves funding flexibility while supporting long-term earnings growth. Cover planned investment, rate-based growth, project returns, operating cash flow, financing capacity, credit metrics, dividend obligations, construction timing, regulatory approval, and downside scenarios. Question 11. What is the difference between a power purchase agreement and merchant power exposure? A power purchase agreement provides contracted pricing and delivery terms with a buyer, creating greater revenue visibility for the project. Merchant exposure means power is sold at market prices, so earnings depend more heavily on regional supply, demand, fuel prices, congestion, and volatility. I would assess contract tenor, escalation clauses, counterparty credit, basis risk, and renewal exposure. A contracted asset generally supports more predictable valuation, while merchant assets may offer upside but require wider downside sensitivities. Explain contracted pricing, revenue visibility, duration, counterparty credit, renewal risk, spot price exposure, basis risk, curtailment, and how the mix affects project valuation and volatility. Question 12. How do renewable energy tax credits affect project economics? Tax credits can materially improve renewable project returns by reducing tax liabilities or supporting monetization through tax equity or transfer arrangements. I would determine whether a project qualifies for production or investment credits, estimate timing, and model any prevailing wage, domestic content, or location-related benefits. I would also consider basis effects, transaction costs, and counterparty risk. The correct evaluation is after-tax project economics, because a project with modest operating margins may still generate attractive risk-adjusted returns after incentives. Mention production and investment tax credits, eligibility, timing, transferability, tax equity financing, basis impacts, monetization risk, and the importance of modeling after tax rather than purely operating returns. Question 13. How would you analyze the impact of weather on NextEra's financial results? I would separate weather impacts by segment and distinguish volume effects from cost effects. Temperature can change FPL customer demand, while hurricanes may create restoration costs, outages, and potential regulatory recovery. Wind and solar conditions affect NEER generation, although contracts and hedges may reduce exposure. I would compare actual conditions with historical normal levels, quantify the earnings variance, and normalize the forecast. I would not extrapolate a one-time weather benefit or setback into long-term growth. Focus on temperature, hurricanes, renewable resource variability, customer demand, storm restoration costs, insurance, fuel usage, normalized earnings, and the distinction between temporary and structural weather effects. Question 14. If renewable generation were 10% below forecast, how would you analyze the impact? I would first identify whether the shortfall came from weak wind or sunlight, equipment availability, curtailment, transmission constraints, or forecasting error. Next, I would calculate lost megawatt hours, revenue under the applicable contract or market price, replacement power costs, hedge settlements, and any tax credit impact. I would compare the result with budget and prior periods, then assess persistence. A weather-driven miss may normalize, whereas equipment or interconnection problems could require a lower long-term production assumption. Include lost generation, contract terms, replacement power, merchant prices, hedges, availability, curtailment, tax credit effects, operating leverage, and whether the variance is temporary or indicative of model error. Question 15. How would you perform a monthly variance analysis for an energy business? I would begin with actual results versus budget, forecast, and prior year, then separate revenue and cost variances into price, volume, mix, timing, and one-time items. For FPL, I would examine customers, usage, rates, fuel, storms, and regulatory items. For NEER, I would analyze generation, realized prices, hedges, project additions, and operating costs. I would validate unusual movements against operational data and finish with a concise explanation, forecast implication, owner, and recommended action. Be sure to explain comparing actuals with budget and prior year, decomposing price, volume, mix, timing, cost, and foreign or market effects, validating data, and communicating actionable conclusions. Question 16. How would you build a forecast for NextEra's earnings? I would build the forecast from operational drivers rather than apply a simple growth rate. For FPL, I would model customers, demand, rate base additions, authorized returns, depreciation, O&M, and regulatory timing. For NEER, I would forecast project commencements, capacity, generation, contract pricing, merchant exposure, tax credits, and operating costs. I would layer in interest expense, taxes, corporate items, and share count, then create base, upside, and downside cases tied to explicit assumptions. Discuss segment-level operating drivers, historical trends, management guidance, approved regulatory assumptions, project pipeline, production, costs, financing, tax rates, seasonality, and sensitivity cases. Question 17. How does depreciation affect your analysis of an electric utility? Depreciation reflects the allocation of an asset's cost over its useful life, so it reduces accounting earnings but not current period cash flow. In a utility, it is closely linked to the size, age, and composition of the asset base and can influence regulated revenue requirements. I would add it back when reconciling net income to operating cash flow, while still recognizing replacement capital spending. The analysis must connect depreciation, rate base, taxes, and long-term reinvestment needs. Explain depreciation as non-cash expense, its connection to asset lives and rate base, impact on earnings and taxes, capital intensity, cash flow reconciliation, and the risk of confusing accounting profit with economic cash generation. Question 18. Why do you want to work as a financial analyst at NextEra Energy? I am attracted to NextEra because it combines essential infrastructure with one of the most important investment themes, the energy transition. The role would let me analyze both predictable regulated earnings and more dynamic renewable projects, which creates meaningful modeling complexity. I enjoy turning operational data into clear financial conclusions and communicating those conclusions to decision-makers. I also value the long-term perspective required for infrastructure investment, where disciplined assumptions and execution matter as much as headline growth. Connect your motivation to energy transition, analytical complexity, regulated and competitive businesses, data-driven decision-making, long-term infrastructure investment, and your relevant technical or communication strengths. Question 19. Tell me about a time you found an error in a financial model or analysis. In a forecasting project, I noticed that a revenue bridge did not reconcile to the general ledger. I traced the issue to a duplicated monthly import caused by an inconsistent date filter. I removed the duplicate, rebuilt the bridge, quantified the impact, and explained the correction to my supervisor before distributing the analysis. I then added a control that checked record counts and total balances against the source file. The experience reinforced the importance of reconciliation before interpretation. Use a concise star structure, explaining the error, detection method, financial impact, corrective action, control improvement, stakeholder communication, and lesson learned without blaming others. Question 20. How would you recommend prioritizing competing renewable investment opportunities? I would rank opportunities using risk-adjusted value rather than headline IRR alone. My framework would consider NPV, contracted cash flow quality, resource strength, interconnection and permitting status, construction cost certainty, tax credit eligibility, counterparty risk, and sensitivity to power prices and interest rates. I would also assess strategic fit, capital requirements, and the ability to scale. A slightly lower return project may be preferable if it has stronger contracts, lower execution risk, and more resilient downside economics. Cover risk-adjusted returns, strategic fit, resource quality, contract strength, interconnection, permitting, construction risk, tax benefits, capital availability, scalability, and downside resilience. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.